My name is Mrs. Boqwana Mzili. I am from Victoria Girls High School in Makhanda from the Sarah Bartman district. Welcome to the ECDOE broadcast studio. Today's lesson is about analysis and interpretation of financial statements. I will be covering this topic for your full understanding. Quick introduction about this topic. We are provided with financial statements for a company or two companies where we need to compare and analyze what is going on. It is always key for you to read the questions very carefully so that you answer it well. Please remember also for each question, you must always quote the name of the ratio and you must always use figures to support your answer. Now we know that we get given a formula sheet at the end of the question paper, and it's important for you to know what does your formula sheet actually mean. So let's quickly have a look at our formula sheet very briefly. We know that we have, this is the first half of it, so the first six ratios, these ones, this one, and these ones, so these six, these are all your profitability ratios. So if they ask you about profitability, these are the ones you talk about. This is solvency, total assets to total liabilities. Then we've got our debt equity ratio, which is all there, the non-current assets, liabilities to shareholders' equity. Then we have our liquidity ratios. Our liquidity, we have all these ones with a star. So it's the current assets to current liabilities, current ratio. This is the asset test ratio together with this one, asset test. This is our stock. The other one is stock holding. The other one is stock turnover. Then we have our creditors payment schedule, and we also have our debtors collection period. So all of these are falling under liquidity. Then the second half, we have our return on shareholders' equity. We have our earnings per share. We have our return on the total capital employed. We have our NAV, which is our net asset value. We have our DPS, which is our dividends for the year. This one works out our interim dividends for the year. This one works out our final dividends for the year. And these ones works out our payout rate for dividends. And this, obviously, our break-even point will be for paper 2. Now, to quickly do some calculations that can be asked to calculate, we'll just do a few here. We have our information. Always check the year. This is previous year. This is current year. And this is the information given to us: sales, operating profit, net profit after tax, current assets, inventory, shareholders' equity, and current liabilities. We are going to work out 4 of these. This question can be asked in question 3 for you to do the calculations, or it can be asked in question 2, which is the cash flow statement. So these are the 4 we are going to work out here: the operating profit on sales, the asset test ratio, the return on shareholders' equity, and the earnings per share. We are told that the number of shares in issue is 1,365,000 shares. I'd like for us to now have a look at the solutions. The first one, operating profit on sales. As the words say, operating profit on sales. As we saw previously, it was 2262,100 divided by 17,800 million, and that gives us 12.7%. Second one, asset test ratio. We know that asset test has to minus our inventory. So this is our current assets minus our inventory to our current liabilities. Now this is the ratio, so the answer is 0.6 is to 1. Our third one, our return on shareholders' equity. This one we take our net profit after tax and we divide it by the average, so half of opening and closing. This is very important. This would be a mark. This is usually a mark. That's a mark. That's a mark. And our answer is a percentage, which is 11.4. So this can be a good 4 to 5 marks question. Then the last one we are doing, earnings per share. This is the net profit after tax divided by the number of shares. And our answer here is 90.5 cents. So that would be earnings per share. So just please remember a few tips when it comes to financial indicators. So do not write out the formula because you will not get a mark for it. Back in our day, we used to get a mark, but you guys don't because you have the formula sheet. Also remember to check the instructions. It's usually said that you must answer to 1 decimal point. And please, very importantly, use the correct unit for your answers. So whether it's a percentage or it's cents, or answer is to 1 if you are looking at a ratio. Okay, so this was just to show you some calculations that you can be expected to calculate. Now let's go into this topic where we are analyzing our information. So if we have a look here on the screen, we see that we are given some information. So here we have some profitability. The first 3 are profitability. Then these 3, these are liquidity. This is solvency. This is all to do with dividends, earnings per share, dividends per share. That's the NAV. That's a debt equity, and so these ones usually work together. And that's the NAV of the shares. So when you get given information, you are comparing previous year to current year. So we see whether something has increased or if it has decreased. And we are going to be asked questions and we are going to answer what is being asked. So always ensure to check the years, that you've got the right years. Sometimes they do it the opposite and they have it the other way around. And always group your ratios together so that you know what to talk about. Okay, then on the next page, we have the return on the shareholder's equity. We can see that that has gone from 18% to 18.9%. Then information B, we are told about the market price of the shares. So with this shares, they've got the market price has also increased from 1340 to 1590. The interest on the loan has remained the same at 13%, and we're going to need that information shortly. And then interest on an alternative investment. Last year it was 7.5%. This year it's 11%. And again, we're going to see that information shortly. Then last information that we have here is about the share capital. We have an authorized 3 million shares. At the beginning of the year, we had 2,050,000 shares issued. 1 month later, we repurchased 260,000 shares. So it means that now we would use that information for us to work out later on. Right, now I'd like to explain a few things. So firstly, when it comes to profitability, as said earlier, we use the first 6 formulae from the formula sheet. These are all percentages, and you must indicate whether something has increased or decreased. So very importantly here is that you must say it has increased from 20% to 30%. So you can't say this is by 10% because in reality, it's actually 50%. Because remember, new minus old over old. So 30 minus 20 over 20 times 100, ne? And that gives us 10 over 20 times 100, and that is 50%. So you cannot say this has increased by 10%. It has increased by 50%. So if you want to talk about by, you need to work out the actual percentage change. Whereas simply just say this ratio or this ratio has increased from 20% to 30%. And then you need to provide a comment whether or not the increase is good or bad. So you must comment to say, is this good or is this not good for the business? So let's quickly do an example when it comes to profitability. The example is asking us that we need to quote and explain 2 financial indicators to show that the company is managing their expenses efficiently. Now, if we have a look at the first page where we had, these are our examples that we're going to use. So having a look at this, we can see that our operating expenses on sales, it has decreased from 19.5% to 13.8%. So decreased from 19.5 to 13.8. The second one, our operating profit on sales has increased from 22% to 24.5%. So this is good. It means that we are controlling our expenses well. It also means that our profit is increasing, our operating profit. Please note that for this question, the percentage net profit on sales has decreased. Therefore, it is not applicable. We can't talk about this one here. So the only 2 ones that are applicable is the operating profit on sales and our operating expenses on sales. Then our next subheading, liquidity. For liquidity, we use the following ratios. We have the current ratio, which is current assets to liabilities, current liabilities. Asset test ratio, which is the current assets minus inventory to current liabilities. We have the stock turnover rate. We have the stock holding period. So stock turnover, how many times our stock is being turned over for the year. And stock holding, how long do we hold our stock for. Then we have our debtors collection period. How long do our debtors take to pay us, which is usually a norm of 30 days. That's the norm for debtors. And then creditors payment period, the norm there is 60 days. So we want our debtors to pay us in 30 days so that a month later we are able to pay our creditors. Let's look at an example for liquidity. So it says here the directors are satisfied with the liquidity of the business. Quote 3 financial indicators to support this statement. So if we have a look again from our example, there are 3 that we can definitely say it's true. The first one, our current ratio increased from 1.9 is to 1 to 2.4 is to 1. Our asset test ratio also increased from 0.8 is to 1 to 1 is to 1. Then lastly, our stock turnover rate also increased from 3 times to 6 times a year. So what this means is that it is evident that the directors should be happy about the liquidity of our business. Then we have a look at our debt equity ratio. I cannot stress enough how important this one is. You will see it in the exam. Every exam will always examine this question. And guys, this is 6 marks, 6 beautiful marks on a silver platter that you can get. When it comes to the debt equity ratio, this is what we are talking about. The debt equity ratio, if it is below 0.5 is to 1, it means that we are at a low risk. And if it is above 0.5 is to 1, we are now at a high risk. So this is comparing how much debt we have to our shareholders' equity. Now, the other thing that we do when we are asked in this question, we compare the return on total capital employed. We compare that to the interest rate of the loan. So if it is higher than the interest rate, it is positively geared. And if it is lower than the interest rate, we are negatively geared. So please, in this question, it's usually worth 6 marks. You need to name the ratios, and I will do an example shortly for you to see. You name the ratio, you say the figures, the trend from to, and then you write a comment about the risk and about the gearing. Let's have a look at an example. So, one of the directors believes that the business can increase their loan for next year. Quote 2 financial indicators with figures to support him. Okay, so from our example, we can see that our debt equity ratio has decreased from 0.8:1 to 0.6:1. This still indicates a high risk because it is above 0.5, but it's definitely less than before. So it has decreased from the 0.8:1. Then the return on the total capital employed, you are allowed to write it out like that. That has increased from 12.7% to 17.2%. This is above the interest rate on loan, which is 13%, and this indicates positive gearing. Those are your 6 marks, guys, on a silver platter. Debt equity ratio, the trend, and then the risk, 3 marks. Then the return on the total capital employed, compare it to the interest rate, and talk about the gearing. And you have 6 out of 6. So please, with that question, make sure you get your 6 out of 6. Right, then the return. So when we look at the return on investments, we are looking at the return on shareholders' equity. And this is how much the shareholders are getting as a return from the business. So you as a shareholder, you went and invested money to a company. You now want to see how much of a return you are getting. You always have to compare this with the return from alternative investments. So I can take my money and go buy shares in a company, or I can take my money to a bank to invest in a fixed deposit. So I need to ensure that I get the best return. So I'm going to look for something that will give me the best return. So shareholders always want to have a good return, and it should always increase. So you want it to increase every year so that you get a good return. So obviously, if the return is low, you might want to take your money and go and invest it elsewhere. So you always want to make sure you have a high return from your investment. I'd like for us to now look at an example. It says here the shareholder of this company that we're looking at, they want to sell their shares and go and invest in a 3-year fixed deposit account. Explain to this shareholder whether this is a wise decision or not. So if we have a look, in this company, our return on shareholders' equity, our ROSHE, has increased from 18% to 18.9%. If we look at the interest on alternative investments, so remember we must always compare, that also has increased. Last year it was 7.5%, this year is 11%. However, the ROSHE of 18.9 is definitely higher than the 11% of the alternative investment. So this shareholder is getting more from this company than what they would get in a fixed deposit. So therefore, the shareholder will not receive a higher return from the alternative investments. So this shareholder should stay with this business and not go to another investment that will only give her 11%. In terms of dividends, so in terms of dividends, we have EPS. This is how much each share earns, earnings per share. We have DPS. This is how much dividend each share will receive. And then when we work out the dividend payout rate, this is DPS divided by EPS, and we multiply it by 100 because we want it as a percentage. If it is high, the business definitely wants to impress the shareholders and keep them wanting to invest. But if it is low, they could be wise and keeping funds for the future expansion of the business. So let's quickly have an example here, then have a look. So comment on the dividend payout policy for this company. So as we saw from the information earlier on, it has increased from 69% to 107%. So that has increased quite a lot for this company. So therefore, that has increased quite a lot for this company from 69% to 107%. So our comment here would be that this company used their retained funds to try and make the shareholders happy. So if they increase our dividend payout, they're trying to make shareholders happy and keep them in the company. And if they decrease it, it means that they are thinking for the future expansion of the business. Then we are almost at the end. We are now looking at the shares. For the NAV, that is the net asset value. That is how much the business thinks the shares are worth according to their books. Then when we look at the market price, the MP, this is how much the shares are worth on the JSE, the Johannesburg Stock Exchange. Always compare these two when you are asked, the NAV and the MP. And shareholders would obviously get very discouraged if these decrease. So as a shareholder, you would want these to increase, showing that you have confidence in the company that it's doing well. So the shares example that we have here, Stanley, the CEO, wants to buy the shares for 9 Rand each without advertising to the public. Now give 2 reasons why you would not support him. So let's have a look at the solution here. Obviously, Stanley is trying to be very dodgy here because all shares must always be advertised to the public as required by the company's law. So because they're a public company, they must advertise their shares to the public. Secondly, a big thing is that he wants to buy the shares at 9 Rand per share. And that is below the market price, which is 15.90 Rand, and also the NAV, which is 10.50 Rand. And therefore, this is an example of insider trading, and it is a criminal offense. He is taking advantage of his position to enrich himself as the CEO. Then lastly, about the majority shareholder. So the CEO, Stanley, he owns 46% of the shares after the repurchasing was done. And the board decided to issue all the unissued shares. So we are now going to calculate the number of shares that he must purchase to gain control of the company. So this is what we will do. The number of shares that we have, it was authorized share capital of 3 million minus the 260 that was repurchased. So this is the number of shares we have out now. Then if a person wants majority, it's 51%. So that would be 1,397,400 shares. Stanley currently has 46% of the shares, which was 1,790,000 shares. So therefore that means Stanley has 823,400 shares of the 1,790,000. So Stanley needs to buy 574,000 shares in order for him to become a majority shareholder. And then the last question, if he buys these shares at 9 Rand to become a majority shareholder, how much would he pay and how would this affect the company? So firstly, if he would buy the 574,000 shares for 9 Rand each, the company would receive 5,166,000 Rand. If Stanley would pay the market price of the shares, which is 10 Rand 50, the company would get 9,126,600. Therefore, the company would make a loss of 3,960,600 if Stanley would buy them at 9 Rand. So this means that this would disadvantage the company. So I hope that you have learned today about how to go about to interpret financial information. Please ensure if you are given two companies, make sure you have the correct company details that you are going to compare. Always have figures when you are supporting your answer. Name the ratios, do your calculations, do everything accordingly so that you can get your marks. We have now come to the end of our lesson. You can leave your questions on the comments, and don't forget to leave the name of your school so that we can give shout outs. Please share, recommend, and subscribe to our YouTube channel. Thank you for watching, and see you on our next lesson.